Yeah, good afternoon everyone for joining us today for the talk. And it brings me great pleasure introducing Harilal Madhavan, a faculty member from the Humanities Department. And today we are all here to witness and get insights about the 2020 Nobel Prize in Economics. This year's Anvesha is being sponsored by Sabari Scientific Supplies and Apparatus. So we welcome everyone for the talk. And Dr. Harilal Madhavan is interested in developmental economics and has worked on multiple projects in the field of health systems and policies, health industry, biodiversity, and intellectual property rights. His lectures in the humanity course have cultivated the critical thinker in each one of his students and have impacted them in a sense of social responsibility and towards pressing issues of the world. Today, he will be talking to us about the auction theory, a field in economics that was recently put on the spotlight by being awarded the Nobel Prize for Economics in 2020. On that note, I'd like you all to welcome Dr. Harilal to give his lecture, and I welcome all the audience too for the talk. Welcome.
Thank you so much, Ravi. Thank you, Anesha team, for organizing the series of talks, and thank you so much for inviting me to be part of this talk. I will start discussing the topic now, but before that I will share my screen so that you can see the PowerPoint. I hope it's visible, right? Yeah, okay. So just to start with the, can you hear me? Oh yeah, sure. Okay now, yeah? Yeah, just to give you some background, you know the Nobel in Economic Sciences is slightly different from the Nobel Prize in other subjects. It's officially known as Sverig's Riksbank Prize in Economic Sciences in memory of Alfred Nobel. The other prizes are known as Nobel Prizes, but this is not known as Nobel Memorial Prize, right? So you must be knowing that, because the other prizes have started much earlier in 1901, but Economic Sciences Prize has actually been offered by the Sweden's national bank, the central bank, Sveriges Riksbank, in 1968 with a donation. The amount, I don't remember exactly, but in order to commemorate the bank's 300th anniversary. So it's a kind of quite a late starter in that sense, but later added to the family of Nobel Prizes, even though there are quite a lot of debate is going on whether it's really belonging to the family of Nobel Prizes or not. But let's keep that discussion apart. So this year's Nobel Prize, Nobel Economic Sciences Prize has been awarded to the two economists who are actually working on the auction theory. They are Paul R. Milgrom and Robert B. Wilson. Both are actually the faculty, the professors of Stanford University, USA. Actually, these are the teacher-student duo. Milgram was a student of Wilson, and Milgram received his PhD in 1979, while Wilson received his PhD in 1963. One is actually a business economist. You can see that it's a DBA, it's not a PhD, it's a doctorate in business administration in 1963 from Harvard. And Milgram is actually a professor in humanities, and he is a professor of management. Wilson is a professor of management. Okay, so the award has been given to court the award committee for improvements to auction theory and inventions of new auction markets. Okay, so the committee, so auction theory we can consider it's a kind of an esoteric branch of microeconomics, if you really think about which branch of economics this is belonging to. And I'm sure microeconomics, most of my students are quite aware about, because they have done at least part of it in the second semester. So it's mainly actually quite related to the microeconomics, and it's mostly dominated by the game theoretical approach. Okay. And the committee noted that they did not just came up with the original ideas of auction theory, but played a crucial role in implementing these ideas. So in terms of both theoretical and practical concerns, I think both have contributed quite a lot to the improvements in our understanding regarding the auction theory. To just give you a background, because that's important, this is going to be quite a non-technical talk, so that everybody can easily understand things. To give a brief about the auctions that we talk in economics, auctions have a very long history. In ancient Rome, lenders used auctions to sell assets they have confiscated from the loan defaulters. They used to do the auction for these kind of properties they have appropriated from loan defaulters. And there is an oldest auction house, which is Stockholm's Auction Work, founded in 1674. Now you can assume that how long this is actually dating back, right? And obviously we have come a long way from there. So various auctions nowadays, you see, very traditional forms of auctions in farm auction, art or painting auctions, call auctions, So there are very kind of traditional ways of auctioning products, come out goods and services in economics, if you call, right? And the electricity charges, if you think about the range of products which come under auctioning system now, you can think about the electricity charges that we pay depends on the regional electricity auctions, because you see that Indian energy auctions is actually one of the largest auctions, nowadays. So that's one thing. And obviously, the spectrum radio frequencies that mobile phone coverage uses, right? That is sold to the telecom companies. And so spectrum auctions, we are quite familiar with it, because we had some, probably 5 to 6 years back, if you remember, some of you may be remembering that we had so much, problems, and we have been discussing about the possible corruptions that happened in the, spectrum auction and things like that, right? So we know about it. So for economists, auctions are actually one of the very efficient mechanisms by which we allocate the scarce resources, right? If you go back to the basic economic theory, you know that we actually use the market mechanism to allocate the scarce resources, right? And market mechanism is basically, I think for some people, I don't know if there is any of my any other than economic students who's there. For them, it's basically the demand and supply interactions, and this invisible hand of supply and demand can work in the market and can actually fix the prices, okay? And that price is known as a kind of market price. So basically, in economic theory, the resources are allocated. That's a pressing problem in economics. We have scarce resources, but unlimited wants. So how do we efficiently allocate the resources to those people who actually need them in the society, okay? And economists considered auctions, along with some of the other options. Auctions are one of the very efficient mechanisms by which we allocate these scarce resources to the society, okay? And economic efficiency is a very difficult term, because it's have a lot of connotations. Probably I'll come to that very sooner. Auction theory deals with the various ways in which auction can be designed to improve seller revenues, increase benefits to consumers, or even achieve both these goals at the same time. Achieving the two goals, that is maximizing the revenue of a person who is selling the product and increasing the benefits of consumers, So these matching these two objectives simultaneously, it's the biggest problem, right, in economics. And it says that if you actually deal with an auction theory in a particular way, subjected to different context, you can actually design a particular auction format which can actually improve or efficiently work in this sense, okay? So there are actually various ways of resource allocation. It's not only auctions. If you really go back to the history, we know that there are something like, the political markets which established in a lot of the centrally planned economies like Russia, China, and all, where, obviously to an extent in India also for some time, this kind of decision has been coming from the center about allocation of resources, but most of the economies now has turned to more of market-oriented kind of approaches. But if you look at the political markets that existed at that time, they had a lot of lobbying, and usually the resources will be going to somebody who is very close to the bureaucracy, or close affinity to the people in power. That is happening. That's not very efficient allocation in that sense. So we cannot call this as a kind of very efficient allocation of resources. And then we have lotteries. It's a very random selection. I don't know whether allocating resources or allocating products through lotteries will actually maximize the value, because we cannot ensure that this product is going to a person who really needs it. Okay, so lotteries and political markets are actually probably a kind of inefficient way of allocation of resources in a sense. But auction helps sellers discover those buyers who value the good most. Okay, because it's going to be the highest bidder, right? So when you actually raise hand saying that I want to buy this product at a maximum rate, that actually gives you a price signal to the consumer. That means the person, this is very debatable, I'm going to discuss it. So basically economic theory argues that if you actually quote a highest price, that is the person who actually need that commodity most. So that is the price signal that we are talking about in the in economics. So basically the commodity or the good would be given to that person who is actually having a better quoted price. So this obviously maximizes the revenues for the sellers. And the basic idea of auction says that allocate licenses so that some of the valuations can be maximized. If you really think about this is going to person who is actually in need of that product, you can see that the value can be added together, and you see that whether it is maximized or not. So in action theory, it is basically maximized. So it's basically the market mechanisms allow the getting prices right. If any kind of intervention of the state or the government in that process probably creates some confusions. My students must be knowing, because I've been giving a lot of examples regarding that. But still there is a concern that is it really the perfect way of allocation? Having enough money to pay for a particular product is actually saying that he is the most needed one in the society. That's a question we have, right? But in terms of economic efficiency, if the sellers are maximized their revenue and the consumers is maximize their utility, that is economically efficient, right? But whether the price being quoted by a person, probably there is another person who is actually in need of that commodity, but he's not able to pay. So a realized demand is only when a person is able to pay and willing to pay. Okay, so if the person is only able to pay and not only willing to pay but not able to pay, then probably the product will not be going to him, right? Because he has not able to quote that price because he doesn't have a purchasing power. Okay, so in that sense we can actually criticize this kind of concept, but in a simple sense we can consider economically efficiency. From a point of view economic efficiency, this is probably one of the best mechanisms we have, right? In simple sense, the auctions happen everywhere. I mean, I don't need to explain this, because in a supermarket manager, he tries to price the products. He can actually have a high base price or reserve price looking at the demand for a product in a week or month, right? By analyzing the data for a particular month, you can see that whether the product is in huge demand or not. So if it is in huge demand, he can actually price it high. And if he sees that this good he has taken, the stock is actually still in the shelf, then he knows that the demand is not there, so he can actually price it low. So it depends on that. He can actually fix the base price in a particular auction, in a fruits market or anything. But apart from this, there are many complex auctions that happens in the economy, which is basically the auctions for capital goods, or for example spectrum. Capital goods are those kind of goods which we used in the production process to produce something else. I hope you understand the definition of capital goods. Capital goods are basically used for the production of other goods. Probably if you think in terms of a public good or a capital good, we can see that a road is a public good or a capital good, or we can say bridge is a capital good, or a factory that is a public, it's a capital good. Okay, so if you think about some of the complex commodities, like for example the radio frequencies case that these authors have analyzed here, they are actually quite complex. These auctions are quite complex. So we have to see that how they are actually quite efficient in dealing with this complexity. Okay. So traditionally, economists had the belief that all auctions are the same in terms of revenues for sellers. Okay. So in any format you follow, or any kind of auction formats you follow, it doesn't matter. Basically, the revenue equivalence theorem, the particular theorem, which talks about, basically the revenue would be equal at any format. Okay, that's the oldest, kind of old understanding. It's a traditional understanding of it. Okay, but we have examples where auction has gone wrong. If you look at the Spectrum auction in New Zealand quite a while back in the 90s, where the winner of the auction mandated to pay only the second best bid. I'll talk about different types of auction very soon. But here you understand that if I am quoting 1,000, probably that's a highest $1,000. That's a highest that I quote. There is a method that even if I win the bid, I don't have to pay the highest amount. I don't have to pay the amount that I bid, but I can pay the amount of the second person's bid, the next person's bid. Which is closest to your bid. Okay, the second highest. And if that kind of procedure followed, then there's a problem. In the case of New Zealand, we have seen that, because the person who has quoted around $5,000 for a Spectrum deal, he has won the bid, but he had to pay only, he has actually bid for 7 million New Zealand dollars, dollars, and he had to pay only $5,000 because that's the second highest bid is quite low there. So that's a huge loss for the government. He didn't have to pay his bid. The method that adopted in that particular bidding process was the second best bid. There is a first best bid where you actually pay your own bidding price. But here the method was different. In that sense, you see that if he had to pay his own bid, he would have paid around 7 million, right? But since the second best had been paid, he actually paid only $5,000. This created a huge difficulty or huge problem for the exchequer of New Zealand, So we have seen that in some cases, auctions are also gone wrong. So that's why we need to really think about what kind of formats we are playing different types of auctions, right? So the contributions of laureates, this year's laureates, have helped the governments and the private companies to design their auctions better for the complex goods. That's a contribution. That's a main contribution. In fact, the Swedish Academy mentions this is a beautiful example of how basic research can subsequently generate inventions that benefit the society. Okay, it's quite interesting to see that one of the Nobel laureates here, Dr. Milgram, has co-founded a firm which is called Auctionomics, which helped the government and companies around the world to design auctions. So not only they have actually theoretically talked about it, but practically helped many governments to really design these auctions. Nobel Committee has actually been referring to their efforts regarding this. So let's briefly look at some of the complexities of auction theory, and I hope it's quite simple and you will be able to understand. And obviously this could be easily mathematically also we can present it, but this is a very non-technical version of it. The outcome of an auction mainly depends on three factors. One is the auction's rules or format, because there are different format for auctions. There are bids open, that open bids or sealed bids, right? There are bids open or closed. How many times participants can build in the auction, and what price does the winner usually pay, their own bid price or the second highest? That's what we have seen in the case of New Zealand. So you see the different formats. There are sealed bids and open bids, and there is a number of times that participant can do the auction, and also there is whether they pay the
the winner will pay the own bid or second highest. And the second factor is the auctioned object itself. Does it have a different values for each bidder, or do they value the object in the same way? If there are 10 members who is bidding in the bidding for a particular object, do all of them have the same kind of attachment or value or a self value that, or a private value? We'll talk about private value soon. Private value for that particular product, or it's different. For a painting of Picasso, obviously you can think about some persons have their have a strong interest in that, and others may not be. For them, it's just a painting. So you can actually see that how a product is attached to different people in different ways. Okay, so the auctioned object is another thing, one important factor, and the third one is the information that is available to them regarding that particular product. What is the real value of that object is in bidding. Most of the times this creates a trouble. We don't know exactly what I'm bidding for. What is the real value of that particular commodity that I'm bidding for? So this information asymmetry or uncertainty that there regarding this particular product creates a lot of problems. Okay, we'll see that what kind of problems very soon. So these factors govern the bidder's strategic behavior and thus the outcome. So it's basically, just like an oligopolic model. I'll talk about it. This is actually a kind of strategic behavior that each firm try to consider. Okay, so these are important factors that they consider while they do the bidding. Hence, how to design an auction to create maximum value depends on all these factors, but it's really difficult, because multiple related objects can be auctioned at the same time. There are a number of things together or packaged, or you see in the case of spectrum analysis, you see that spectrums are actually sold in different blocks, different geographical areas. So when they are sold together, that creates complexity, because you have to look for all these kind of things, whether how many people are there, what kind of method is been following, and what is the value of the exact auction at a particular geographical area, and things like that. Okay, and if you look at the types of auctions, there are two types of auctions. One is English auction, that's a usual one, in which auctioneer begins with a low price and subsequently move to higher prices. Okay, you start from a low price and then slowly move to the higher prices, and the participant can see all the bids and choose whether they want to place a higher one. So it's an open one. Okay, you can see that what is the other people are actually bidding for, and whoever has placed the highest bid wins and pays what he or she has bid. Okay, basically they pay their own bidding price in the English auction. And Dutch auction is on the other way. It starts with a higher price and eventually lowered until the object is sold. Okay, so if you start from 1,000, and this is actually creating a lot of troubles. I mean, we'll see that, because this you start from the highest base reserve price, which is actually very high, and then there will be people calling for bidding, which will be lowering the price, and the first caller will get the get the bid, right? If it's the highest one, right? So that's a point. So it starts from the highest one to the lowest. And English auction is the other way. That's a usual one we see. Even in the case of fish market, we see that it's starting from the lowest and then kind of go to the higher prices. Okay, so there are two kind of types that we have seen, English and Dutch auctions. And the above types, it's a straightforward open bids. Each one know about their bids. It's basically open kind of bids. There are other types where the bids are closed. For example, that in the case of public procurements, like public facilities that the government wants to do from a particular agency, they actually invite different types of bidding, and they will look at the they will have a very stipulated specification that the company or the agency should have specific quality requirements or experience requirement they will be putting up, and chooses a service provider that commits to perform that particular job at the lowest cost. Okay, so that this is a kind of closed kind of bidding. This is a public procurement. This is actually in the case of public procurements. But sure, if it's a government kind of bidding that you're doing, you have to be aware about the quality requirements. So, and some are first price auctions and others are second price auctions. We have seen that, right? Either you pay from your own bidding price, you pay your own bidding price, or second best option, right? So which type is best and which format is best? It's very subjective, because the best itself is really a kind of a subjective question, right? For a private company, it's actually the one which gets them the maximum revenue. For a public or a state, when they are doing the bidding, it's not only the profit, but basically how does it do the welfare for the society, right? So in that sense, it's basically a very subjective if you choose which one really suits which kind of situation. So the best strategy is actually, it's a very game theoretical kind of view where, the firms will look for, or a particular bidder will look for the other's strategy, and they will act accordingly. Okay. At some time, there is actually collusion in the market. It's not collusion, it's collusion in the market, which is a cooperative game. They may join hands and then, work against a particular giant, right? That's also possible. So now, this is very important. There are two types of values involved. I mean, this is the contribution that comes from the laureates. There are two kind of values that involved in the in the product. One is private values. I mentioned it earlier. So it's not the first time that the Nobel is actually giving to the auction theorist. There is Dr. William Vickery in 1996 has been awarded. And he established, the auction theory quite early, and he specifically analyzed this issue, the private values of a particular commodity, and what is its role in auctioning. Okay, so what is the private value here? Like as I mentioned, for a particular painting, you may have your own personal, weightage for it, right? You have a private value assigned to that particular good, right? For example, a particular old model car, you may have some craze over it and you will ready to pay a very high price, right? So this is a private value. So if a commodity only have a private value, then this is actually independent for different people. Whoever bidders are there, for them it's different. It's not a competitive pricing. I know that, I am ready to give for a particular model of car this much price, and I don't want to go beyond it, because for in my mind, that particular product worth that much, right? So I'm ready to pay up to that amount. So for like that, for each bidders have their own amount fixed in their mind. Okay. So what William Vickery, who has won the Nobel Prize in '96, has argued that if all bidders are rational and risk neutral, they are rationally behaving, then if the commodity having only private values, that will fetch the same expected revenue to the seller in both English and Dutch format. Whatever kind of format you follow, whether you start from a lower bid to higher bid or higher bid to lower bid, that's what the difference between the English and Dutch format, right? It will actually look at the private value that is there in your mind, right? So you will fix the price at that particular amount. You will fix the bid at that particular amount, and you are not ready to go beyond it, obviously, right? So that there is a particular expected revenue to the seller, in that sense. There's a particular revenue that has been attached to it. So there is no confusion regarding that, right? If the product has only private values, but there is something else. Most of the commodities have a common value. Common values are that part of value which is equal for all bidders. I mean, this is nothing emotionally attached or anything like that. It's basically equal for all bidders. So entirely private values are in extreme cases. It's not possible that, I mean, it might be, but usually it's not possible that a product have only private values, but it has common values. Okay. So most auction objects like property, car, or securities, most of them have a common value. If you think about a car, the common value is its resale value. That's a common value. That's true for everybody. For example, here you can think about a diamond dealer in the raw diamond market. He wanted to contemplate a bid on the raw diamond. Raw diamond, the basic use of the raw diamond is you can actually provide a cut diamond, and you can cut the diamonds from it and provide, sell it off, right? And also it has a certain level of quality. So your willingness to pay or a demand that particular commodity, that particular diamond, or bid for that diamond, it all depends upon the common value, which is the resale value of the cut diamonds. And it obviously depends upon the number of diamonds that you can take and the quality of that particular diamond. Okay, so depends on your expertise and your experience, you attach a common value to it. So if I am an expert in diamond, various types of diamonds, then I know that what is the value of it, right? So you can get a better idea about it. But there are also possibility that you don't know the real value of or common value of that particular commodity. That's possible. We don't know actually what is the real value of the commodity. And in this sense, in this case, there is a biggest problem. Some bidder who actually assign a particular value, which might be not the true value, but it might be very far from the true value, but he is a very optimistic bidder. So he kind of overestimate the common value, and he will end up paying more because he may got a very high bid price, bidding price, where he will win the bidding, but at the same time, the actual value of that commodity might be much lower than the bidding price. So in that sense, he lose there. Okay, we call that process as winner's curse. So even though he win that process of bidding, he end up paying much more. He end up causing a loss. Okay, so I hope that's clear. So a winner's curse can happen in the case of it's kind of misunderstanding the common value of a particular good that is there in the bidding. Okay, and 3 classic papers of Wilson, that's a contribution. So Wilson has contributed more into this idea, the common value of a particular good and what happens to the winner's curse and things like that. Okay, so in the 1960s and 70s, the major findings he came up with are basically he is talking about 3 things. One is the participants will bid lower than their best estimate of the value to avoid the extent of winner's curse. So even though you kind of try to, if you have no idea about what is its true value, the participants will bid lower than their best estimate. That's what he found. So usually you don't really, even if you overestimate it, you try to avoid that by paying less. Here bidding price would be lesser than that. And if there is greater uncertainty, bidders will be more cautious and final price will be lower. So, I have a lot of uncertainty because I have no idea about it. So I will try to be very cautious in putting my bidding. So I'll pay only very less price, right? So the problem caused by winner's curse will be larger if some of the bidders have a lot of idea about that product and some doesn't have. Okay. Probably in the case of New Zealand case, probably you can think about this is the problem. Some bidders have no idea about how much it's a real cost of it, value of it. So they actually bid a very lower bid for that, and some were actually very very overestimating it, and he was ready to pay 70 million, but he was happy. It's not a problem because it was the second best pay. So he had to pay only the second highest option, right? So that's also possible. So in the case of, the case here is some bidders have very better idea about the value of the product and some doesn't have that idea. In that case, you see that the disadvantaged firm will either bid very lower price or remain abstain from the auction. Okay. And first price also this can happen. I'm not going to talk much about that because it will eventually, if you're actually having a lower bid, whether it will really impact on the consumer's welfare, we don't have any idea. It all depends on what kind of market we have. It's a very competitive market, then obviously there'll be prices lower, as you see in the case of the telecom markets in India now. Okay, if the competition is there, then probably there is a low price. But if there is only 1 or 2 firms, agency working in that particular product, then there is a possibility of higher pricing or a monopoly pricing. So in most of the cases, what the Nobel laureates argue that there is a coexisting of both private and common values. Okay, so this creates a lot of trouble. Like for example, there are different examples as given. For example, apartment. For apartment, the common value is the resale value, that for everybody it's the same thing. And private value it's different for different people because it depends on how much you appreciate its condition and what is the location advantage, whether you like the location of that particular apartment, and what is the floor plan. It's all depends on that. Okay. And in the case of right to extract natural gas, the common value is the size of the reservoir. Okay, that's common for everybody. And the private value is what the technology that particular company has. Probably a company A has a better technology to extract that gas from there, so they can actually produce at a lower cost and they can gain much, right? So their private value for that particular natural gas extraction is quite high, right? And a bank bids for government bonds, for example. You see, the common value is the future market interest rate. That is almost kind of fixed one that everybody knows. And the second thing, what kind of customers and how many numbers of customers want to buy their bonds. If the bank knows that they have enough customers to buy their bonds, they can actually bid high. They can actually be competitive in their bidding, right? So that's true. So here, in the case of coexisting values, if there is common values as well as private values, in most of the auctions, the demand of the bidder depends on, or the willingness to pay of the bidder depends on both these values. Okay. Analyzing this, that's a major contribution of Milgram, one of the Nobel laureate. He has done commendable work in the 1980s. He mentioned that in an English auction, there is actually something advantage here, because the auctioneer basically starts with a very lower price and then slowly raises it, right? So by slowly doing this, the bidders who observe the price at which other bidders drop out from the auction, that gives him an information about the actual valuation they have in their mind, right? So what is that bidder's valuation for that particular product? You will understand, because if a person opt out at the 500 euros, you can say that that person's valuation was only up to that much, right? So in the English auction, because you start from the lowest to highest, this is possible that you can understand that generally you understand the general valuation of people, the bidders, and you can actually look for or wait for your own expected value. Then you don't really overestimate it. You can see that what is the general kind of understanding about the value of that product, right? But this is not possible in the Dutch option because you start from the highest, right? If somebody calls a price, he will get it. So in that sense, there is a risk involved. So maybe a person end up paying high, because there is no option of kind of sorting out people by understanding their bidding price here, because you are starting from high, right? So in that sense, in English auction, we have that particular option. So this also shows that if the bidders have better information about the value of the product or object, this can result in optimum bidding revenue. So this has resulted the Nobel laureates to suggest the bidding companies to give more transparent information about the value of the product to the bidders, so that both the bidding price, the revenue, all can be maximized. Okay. So it is advised that a proper information should be given before the bidding starts. And one application, I'm talking about one example that they have contributed. It's actually in the case of the US spectrum sale, the radio frequency sale, because in the earlier period, basically the US authorities, they are just giving it away, the radio frequencies, or selling it at a very lower cost. One method they adopted in the beginning it's called beauty contest. Basically it means the companies provide arguments about why they want to receive that particular license for radio frequencies. The telecom companies have asked to produce their own arguments to get that license, right? And this is obviously politically influenced, easily lobbied, because they spend a lot of money for lobbying in that purpose, and ultimate revenue that government gains is less in the case of beauty contest. And after a point of time, they understood that the government is not gaining much from this particular format. Then they have shifted to lottery method, and lottery method is also a very kind of random allocation, created only a very limited income, because you don't know it's going to the person who actually won that, right? So this is the Federal Communication Commission, FCC, who was in charge of dealing with the radio frequencies and mobile telephony in USA, they actually found that lottery method also not very efficient, and it's causing huge problems to the US exchequer. They could have gained a lot of money. And so the FCC has actually thought about an auction format, and they have actually approached the Nobel laureates, and they actually thought about how do you design an auction that achieves the efficient allocation of radio frequency bands, while at the same time benefiting the taxpayers. So how do you produce something like an efficient one for both the producers or sellers and for the taxpayers? So they wanted something like that. So FCC approached them for an auction format. And this is tough because it has a common value, it has a private value, and also the value of a specific frequency band. There are different blocks in the US, and each one actually been locally been done, locally been bid, and there is a possibility that there is a huge speculators working in some particular region of the US and take that bidding process, or hijacking that bidding process there by paying a huge amount, because they know that if there is a particular agency who want to be a national wide, they want to cover the entire US, for example. They cannot do it if some of the areas have been taken by somebody else. If you're actually only bidding for the particular geographical areas, it's fine. But if there is a bidder, for example, if the Vodafone want to bid for spectrum in India, if they want to take everywhere, all over India, then it's actually benefitable for them. But at the same time, there are some speculators who see the possibility of getting some geographical regions, for example, Kerala and Tamil Nadu, they get it at a higher price, and then you see that there is a secondary market open because they can bargain with the largest agency for a very high price. That will lead to a lot of problems in the secondary market, because they can actually create problems, because they can argue for a huge price, right? This creates problem even in the US, where these agencies who want to get the spectrum overall, they actually want to avoid this problem, because they see that this has been created, because this spectrum sale happened in different regions at different times. So this created a lot of trouble for them, because if you don't have, it's broken connectivity in some regions will create a problem, right? So they wanted even that region to be included in their one, but they have to pay a huge price for that if somebody else taking that, right? So to circumvent this, Milgram and Wilson suggested that there is a possibility of simultaneous multiple round action, that is SMRA, which offers the entire frequency in different region to bid simultaneously, okay? Starting with low bids and allowing repeated bids. So when simultaneously it happens, then it's difficult for a speculator at a particular region to, hijack the bidding by paying a huge price, right? And simultaneous ascending auction rules that they have followed, that's a particular method, which has in which all licenses are auctioned simultaneously, and also all licenses have been closing at the same time. So this particular method that's suggested by the Nobel laureates solved the problem of uncertainty and also a winner's curse to an extent. Winner's curse, I hope you remember. They unnecessarily end up paying huge money. But here that it's a kind of English auction method, but simultaneously done, right? So in the new model, you're seeing that the US government has gained around 617 million US dollars in 1994 alone. And in the 20 years time, they have gained around 120 billion US dollar, which would have been otherwise, just given away. So through the new auction format, you see that it has made a huge impact by increasing the revenue of the government. And it has raised around $200 billion globally, because many countries like Canada, Finland, India, Norway, Poland, Spain, UK, many countries have adopted the same format for their spectrum auctions. And India is also doing the same kind of format. So they have been refining the format, obviously, over time, by adding more specificities to it, by incorporating the various ideas coming from computer scientists, mathematicians, behavioral scientists, etc., mainly to reduce the manipulation and cooperation. There is a possibility that there will be cooperation between some particular bidders, and then jointly bid against the other one, right? So they want to avoid these kind of collusion possibilities and all. And I'm not going to explain this. There is an incentive auction method that has also been introduced by Milgram. And if you go back to the documents of the Nobel Prize, I mean, probably you will see that. So, but this is really a significant contribution and which gained very practical significance in the mid 90s. I'll stop in 2 minutes. So if you look at the India's 2015 spectrum auction results, you see that different states have been taken by different companies, Airtel, Idea, Reliance, Vodafone. So this is also based on a simultaneous bidding process, where you see that in some cases there some companies have joined together. For example, in the case of Kerala, you see that Vodafone and Idea have joined together and taken the ban. So if you look at, and I mean, this is considered to be very successful in the beginning, but because the 3G auction, the 2010 has given a lot of revenue to the Indian government. But there are so much, problems that comes raised now regarding the success of this. I'll talk in a while. So basically, the contribution, in summary, the contribution of the laureates have helped the governments and the private companies design their auction format better, which in turn helped a better allocation of scarce resources, and also helped them to maximize the seller's revenue. That's important. It is believed that the lower return due to the winner's curse may tax the consumers more to, this is one thing. If you actually have a winner's curse, for example, in a bidding process, a firm is end up paying huge, probably they paid huge for the bidding process, means they have less money to pay for other kind of infrastructure facilities, possibly. And also they may charge the consumers so much high, So that's a kind of debatable thing. And that's been warned by the Nobel laureates about that, right? But there are many other economies in the opinion that it doesn't work in that way. In India, the model was initially applauded, but there are also a lot of critiques coming about. It's interesting to see the critics here. For example, in the case of India, a focus on high revenue for government through the auctioning of the spectrum has resulted in stunting the growth of this sector. If you see that there is a lack of competition in the sector now, kind of recently, because one particular firm or telecom company has actually been gaining quite a monopoly power, okay? And this actually led to a kind of loss for most of the companies, and many of them have even exited the market, right? So because they actually end up paying a huge revenue to the government, and that actually also keep delaying the rollout of 5G. 5G has not actually rolled out yet. It has been planned for, I think, this year, but it has not happened yet. So it's because of the high payment for the spectrum, lower its profit, and less left to invest in the better infrastructure. And high fees here have led to the high debt and led many investors, like many telecom companies, to leave the market. And spectrum scarcity also create problem, because if you see that the density of spectrum in India, it's like 50 times of Russian spectrum density. There's a lot of congestion in each spectrum megahertz, that bandwidth. That's create a lot of trouble. I don't know how far we will be able to continue with this. I mean, I heard that in the 5G, there is new technology need to be adopted, for which they have to start an entirely new bidding kind of, probably a lot of new investment is required. So here we see that, there are also problems associated with this kind of bidding process. It's one of the critiques that's been coming up. And the second important critiques can be thought about, this is very, we can call it, goes along with the neoliberalist approach, whether higher price is considered to be, the most efficient. The basic assumption of the auction theory is highest bidder will serve the public interest by using the goods in a most efficient way. And we are not sure about it, right? So that's basic economic efficiency argument, okay? So we need more clarity regarding that. And at this particular point, this also helps us to think about whether resource allocation need to be more decentralized and community driven, as the recent pandemic has exposed many limitations of the very market-based economic mainstream thinking process. So in that sense, probably some of these can be criticized, whether this is a very mainstream kind of concern that Nobel Prize to be given, because we have more pressing concerns like poverty, inequality, and all in this kind of countries. So, why did the Nobel Committee has decided to give to a particular area like this? So there are kind of a lot of critics that can come up, right? So I stop here. So these are the major works of the Nobel laureates, and I hope if you want more readings, I can provide it if you want later. And thank you. I'm sorry, I have taken more time. Yeah. Yeah. Correct. Yeah. Yeah. That's why, in telecom, that's a very complex thing, whether because it has talk time, it has actually data services, the radio frequencies itself is actually a very complex package, that's why the analysis is specifically mentioning radio frequencies, whether it is in India or anywhere. So how do you consider very different kind of interest which is serving by these companies need to be incorporated into the bidding format? That's why if you go into each and every format, probably I'm incapable of doing it because I'm not an auction theory expert. But basically, if you look at the works of their own firm, Auctionomics, actually looking at each company's specificities, or each, for example, telecom company itself, it's that specificities have been particularly looked in and then develop the format. So you're exactly right, because it's a very complex service. It's a package kind of service they provide. So each has a very different purpose, and how do you accommodate this purpose and provide a better auctioning strategy is something. So it's basically an engineering approach, right? How do you maximize the benefits in both sides? That's what actually they have been looking at.
I had one question.
Yeah, Ira, tell me.
Do auctions have like a tendency to encourage like monopolies?
Yes, in some extent, yes. I mean, it can happen in a competitive way also, but mostly yes. Monopolies can be created because in telecom section also it's possible, right? So, but in the case of India, you see that there is actually an oligopoly structure here, because there are around 8 to 10 companies have been actually working for it. But otherwise, it can create, because if it's a product that has been bidding is having not many substitutes, it's a very particular kind of product, then it can create a problem, because that particular product is actually entirely owned by a particular company. Then they can actually fix their own price. We have raised this problem when there was a sale of the recent debate over sale of the services in the airports to Adani, right? So there have been discussion about whether this can actually lead to a kind of monopoly power of different companies. That's possible, very much possible. Depends on the type of commodities that you are bidding for.
Thank you.
So there's a question in the messages.
Oh, yes. Okay. As we are telling, there is always scarcity of resources and existence of higher demand, and that we need to allocate resources to people who really need them. But how is auctioning an efficient way to do the same? Yeah, a particular buyer might really need the resource. Exactly, that's a point. I mean, we are talking about efficiency exactly in the case of economic efficiency. Economic efficiency basically looks at only maximization of benefits of the customer and the producer. And if that has been satisfied, obviously, yes. But here you are talking about the equity part. Even though I need the commodity most urgently, I may not be able to pay for it, right? So that's why I mentioned that there is a problem of willingness and ability to pay. So auctioning is probably quite effective in terms of its economic efficiency point of view, but not at the equity point of view. Here, it may not be actually, I agree quite with, I quite agree with you that it can actually go to a person who doesn't need it, but only looking at the profit maximization. But market here, economics mainly recognizes his ability to pay there, and his price signaling is considered to be equivalent to he value the commodity most. That's a problem. But obviously, equity is a major point. And since equity is a major point, I think that the market cannot deal with it. That's why we need the intervention of the state at some point. Yeah. From IRA, the auction may not necessarily be won by the bidder with greatest need. Obviously, yes, I agree. I agree with that. Possible, yeah. It can lead to a hoarding sometimes, because that's why IRA has asked about the monopoly that can be created. Exactly the same point. It can actually create, but that's why we can actually conceptualize the charity activities in this sense. You see, if I have the ability to pay, but I don't want to buy that commodity, but if there is another person who has no ability to pay but willing to buy, then I can actually pay for him, right? That is something the charity is. I have the ability, but I don't have the willing to buy that commodity. But I would be happy if he gets the satisfaction. Then I can actually offer the ability what I have to get the commodity for him. That's what the charity is all about. So the government can do that. When the government do it is not charity, it is actually welfare activities, right? So that's why we have subsidies, and that's why we have infant industry production and many types of government interventions to deal with it. But basically in economics, we believe that the economic efficiency what matters. Ashwati has a question. How does second highest price auctions work? If I have a certain amount of money with me, provide that I know I need to pay only second highest price. If I win, then I can quote for higher price than I have. This is basically simple because it's a concealed bid. Okay, here you don't know it's not an open bid, so you try to hide it. You try to give a value to a particular commodity, and then you, for example, you quote 50,000 for a commodity, and that's the value you have given, including the common value and the private value that I talked about. And another person doesn't really know what exactly the commodity is, and but the other bidders together, they think that on an average this is the value is around, let's say 20,000, and I am paying 50,000, and let's assume that the true value is somewhere around 30,000, right? That might be the true value, we don't know. But quoting 50,000, I am actually putting it upfront, saying that I am ready to pay that much. But at the same time, you also have the idea that if I am getting the bid, I don't really have to pay. That all also depends on the other people's common values. In that sense, you have a tendency to keep your bidding high, because anyway you are not end up paying that, right? So that can happen. So here, I think you got confused with the open and closed bidding. This is actually, we are talking about the closed bidding. So in that case, this can happen. I hope it's clear. Any other question? Yeah. Does the Dutch auction method actually gets used? Yeah, I think so. At some point of time, you can use it because, some sellers might want to have a very high reserve price. That's possible, right? He want to give a high base price and see that how much he fetches it. That particular problem. I don't see that is there. I don't know. Might be there, obviously. That's why it's considered to be one of the two main type of auctions. I hope it's there. But that's why they are mentioned. It has actually an inherent problem that there is a problem that the bidders will end up paying high than the true value, because you don't really get a sense of what others have have understanding about the value, what exactly the value is, right? So you may end up paying high. That's a winner's curse. So the chance of winner's curse is more in the Dutch auction than the English auction. Yeah.
Any more questions from anybody?
I'm sorry, I'm not an expert in this area, but I just try to give you a kind of very bird's eye view on this. I'm basically confined to kind of development kind of concern, but this is actually a very mainstream kind of idea that economics have. Yeah. If any questions, please.
If no questions, it was great to have insights about the auction theory, because I think most of the people were unfamiliar with, and very non-technical and a very intuitive lecture on this thing was very helpful. And we would like to thank, on behalf of Anvesha and everyone here, I would like to thank sir for providing his time with us, and for a great lecture. Thank you, sir. It was wonderful.
Thank you so much. Thank you so much for this opportunity. I hope it helped. Thank you so much. Bye.
Yeah, thank you.